Welcome to Chapter 6 of our Analyzing Financial Statement course. You may notice that each chapter title has been converted to a question that is consistent with the approach that I recommended at the very beginning of our class. So the title that you see for each PowerPoint that I present will vary slightly from the actual title of your textbook. In any case, we are focusing in Chapter 6 on the income statement, the first of the three major financial statements. And the purpose of this analysis is to determine the accuracy of the financial information, the financial performance reported for the period specified in the income statement. We're also wanting to determine if the information presented represents a strength or a weakness for that particular client, and how likely is it that they are going to be able to sustain if the performance is in fact favorable, or improve their financial performance if the historical data suggests that they are not doing as well as we would like. And so we begin, as we have done in previous chapters, with a recap of some of the key takeaways from the previous chapters. This is probably getting old for us, but again, financial accounting focuses on the transactions that then lead to financial statements, whereas the analysis focuses on the financial statements, how they were constructed, what assumptions were used, and so on. The other key point is that the financial statements that we analyze are impacted by several factors, not the least of which are things such as the operating cycle, the business sector, whether it be agricultural, retail, wholesale, or service, and the structure of that business, sole proprietorship, partnership, limited partnership, S corporation, and so on. In addition, the life cycle of the business, whether they are in the growth stage or the decline stage, these will affect the information contained in the financial statements. And last, but certainly not least, the accounting method used is a very critical factor. Recall that the accrual method is the preferred approach if the statements are going to conform to generally accepted accounting principles. We also noted that the type of loan, line of credit, term loan, lease agreement, standby letter of credit, and so on, the purpose, the repayment sources, primary and secondary, and the term of the loan should all be in congruence. So the purpose should match the type, the repayment source should match the type and the purpose, and so on. And then we focused on the accrual method, which is one of the three methods that were discussed. And we said that with the accrual method, we are recording revenue when it is earned as opposed to when cash is received. We record expenses when they are incurred as opposed to when they were actually paid. And so we get a more complete I said accurate here, but a better phrase would be a more complete picture of the business when we use the accrual method. The three major financial statements: the income statement, which shows the financial performance over a specified period, month, year, quarter, as so on. The balance sheet, which focuses on the financial position. Where are you today? Where is the business today? What do they own? How much do they owe to outsiders, which would be liabilities, and how much does the owner claim against the assets of the business, which would be the owner's equity. And then the statement of cash flow, which focuses on the sources and uses of cash. We will be focusing in this chapter on the income statement. And so recall that some of the key tools that we can use when we are performing a financial statement analysis include a trends analysis, a comparative analysis, a common sizing that we could then use for trend and or comparative analysis. And there's also financial ratios. We will be discussing approximately 20 of those ratios in a subsequent chapter. So let us move on now to the income statement. And the question that we're asking here is, what exactly are the key components of the income statement? And we're looking first at a service firm. However, recall that there are three questions that must be answered in the title of a financial statement. Who, which would be the name of the company, in this case, ABC Services. The what, which should be the title of the report, in this case would be income statement. And the when, which would be what period. So is it a month? Is it a year? As in this case, all three should be answered in the title of that report. And then we have revenue. The question here is how and what caused the revenue that we're reporting. Then we subtract operating expenses. We would want to know how these amounts were recorded. And then we have what we call selling, general, and administrative expenses plus interest expense. These would be subtracted from the sales to determine the profit of the business. And so when you subtract these expenses from the revenue, we have what is called operating profit. And it should be positive. Of course, it's possible if a firm is in the early stages, for example, the startup phase, that may not be the case. We then have other sources of gains and losses that would be included if there are any. The difference between a gain or a loss versus a revenue and expense is what is the primary business of the firm. So let's say this is a service firm and it's a barbershop. Then the revenue from providing cutting of hair would be revenue. But if they have a candy dispensing machine, then we would classify that as income because it's not, or a gain. Or if they were to sell, let's say, items that are not their primary source of revenue, then it would be in the gain category. The same thing is true for losses. Expenses would be from your primary operation. Losses would be secondary. So if you sell a piece of equipment, but you sold it at less than the book value, there would be a loss. Then we have the profit before taxes. And of course, we would then subtract the taxes to get the profit after tax, sometimes referred to as the PAT. So just some things for you to note as you're looking at the income statement. How was the revenue determined? Was it at point of sale? So the customer gets the product and makes a payment either by cash or credit card, or was it percentage of completion? For example, you're a contractor, and as you perform a particular service, you will get a percentage of the total amount. So we would want to know that. But these are all questions that would need to be answered as you perform your analysis. And again, you're looking for some patterns here. As the percentage of sales increases, we would expect that there will be an increase in the expenses, but is it proportionate to the increase in sales? Or the expenses just completely out of line with what is going on with the sales? Questions that would need to be asked, and hopefully we would find the answer or obtain the answer. Common sizing, we talked about that as a tool where you would take each item on the income statement and express it as a percentage of total sales. And then you can use that to perform your trend analysis, because you would have several years of the income statement. You can use it to do a comparative analysis, or you could also look at, not or, but and you could also look at the sales mix. What is the makeup of the revenue? Maybe for a service firm, that would not be as critical, but it could be. The barbershop, is most of the revenue coming from haircuts, or is it coming from another type of service that they're providing? So what is the mix of the revenue? Let's move on to another type of business, which would be a merchandising firm. Remember, I said that the business sector would determine the nature of the financials. Well, same thing applies here. If you're a merchandising firm or a wholesaler, in other words, you're selling a product as opposed to a service, again, the same three questions would need to be answered in the title. However, your sales now will be coming from inventory, not from a service. And so notice that the subtraction here is for cost of goods sold. So we take the cost price of the item sold, the inventory sold, and subtract it from the revenue that was generated. That gives us our gross profit. And then we would subtract operating expenses, along with, in general, selling, general and administrative expenses, along with any other depreciation expense, and we would have our operating profit. So similar approach, but the key change here is that we would have a gross profit calculation, which is the revenue minus the cost of the merchandise that was sold. But again, same general questions. Is this from a point of sale, or is it percentage of completion? We're looking for the trend in the changes in the expenses in relation to changes in the sales. Are they keeping the pattern, or do we see that the changes in the sales are faster than the changes in the expenses, which could be good, or is it the other way around? Then we want to look at the way that your cost flow assumption can affect the income statement. So this would be primarily for businesses that sell a merchandise. There are assumptions that one can make regarding how inventory flows in and out of the business. In fact, if you ever have gone grocery shopping, let's say you're buying milk, and you find yourself reaching to the back to get what you think would be a fresh bottle or can of milk, that's because you're making an assumption as to how the shelves are packed, right? So you're assuming that they're pushing the older items to the front and the newer items are therefore in the back. Well, That's an assumption. And a similar assumption is made regarding the flow of inventory by a business. And that assumption is not necessarily the same as the physical flow of the inventory. So let's illustrate that with a simple example. Let's assume we have a business that has at the beginning 10 units of whatever the product is, and they were bought for $1. So that's a total of $10. And we bought another 10 for $2. So now we have 20. 10 times 2 is 20. So total inventory at that point would be 30. And then we bought 10 more at $3. So $30. So 30 plus 20 plus 10 would be $60. So we have $60 worth of inventory. And let's say we sold 25 of the 30 for $10 each. What would be the profit that we report? And the answer is it depends. It depends on what the cost flow assumption is. One assumption could be that the last item that comes in is the first item to go. So this is referred to as last in, first out, or LIFO. So we sold 25 units at $10 each, so that's $250. That will be the case because that's the reality. We sold $10 each, 25 items. But what is the cost of those 25 items? Well, based on our assumption that the last item we purchased is the first item to be sold, then we would start by assuming that we sold all 10 of these, so that's 30. Then we sold another 10 from here, so that's 20. 10 times 2, of course, would be the $20, so that's a total of 50. And then we would sell 5 from here because we sold 25, so 5 times 1 is 5, so that would be $55, right? 30 plus 20 plus 5. That's 55. So the cost of the 25 units is $55. And so we would show a profit of $195. And we would end with 5 items left in our inventory, which would be 5 times 1, which would be $5. So under LIFO, we're assuming that the more recent items are the first ones to be sold, and therefore any inventory that is not sold is more likely to be ones that were bought earlier in the year or the period. Notice also that the pricing suggests inflation. Prices are going up, and that could also be a factor in terms of the profit that we report. So let's see what happens if the assumption was the opposite. The first item coming in being the first item to go out, as opposed to the previous where the last item that came in was the first to be sold. So now we still sold 25 at 10, so that's the sale of 250. But where did we take those 25 items from? And again, this is an assumption that we are using, and we have to be consistent. The business has to be consistent. So they cannot use LIFO 1 year and then switch to FIFO the next year. It has to be consistent. And so where would the 25 items come from? If the first item that came in is the first to go, then the 25 items, they would have sold all 10 of these. They would have sold all 10 of these. So that's 10 plus 20, that's 30. And they would have sold 5 of these. So 5 times 3 would be 15. So that's 45, right? 10 plus 20, that's 30, plus the 15, that's 45. And so the gross profit there would be 205. Notice that the only thing that caused the more favorable scenario was the cost flow assumption. They didn't sell more or anything like that. They simply used a different assumption, and that is what caused the more favorable performance. And so one of the general conclusions that we can make here is that during a period of rising prices or inflation, your FIFO is going to give you a larger profit than LIFO. And that's because we are using the lower priced items first compared to LIFO, where we're using the more expensive items first. We are assuming that we're selling the more expensive items first. That also affects the balance sheet because notice that the 5 items that are left under FIFO would be the ones that were purchased recently. So here it would be 5 times 3, which would be $15 for the ending inventory compared to $5 for ending inventory. Which one is correct? Both are correct. It's the assumption that made the difference. And so you would want to know that when you're doing your analysis. There's a third assumption. It's called the weighted average method, where we don't assume first in, first out necessarily. We simply take an average of all the items available for sale. So we take 30 plus 20 plus 10, that's 60. Divide that by all the items available, which would be 30. So 30 into $60 would give us $2 per unit. And so the 25 units that were sold would be 25 times $2. And so 25 times $2 would be $50. Subtract 50 from the 250 revenue, we get a gross profit of $200. Notice that the weighted average method strikes a balance, if you will, between the LIFO method, which shows you a small gross profit, and the FIFO method, which shows you a huge, or I should say larger, gross profit. It lands between these two extremes because, like averages, you tend to get that kind of effect. So remember, the assumption is just that, an assumption. It doesn't necessarily match the physical flow of inventory, and it's not required to match. So you need to know what assumption was used by your client and verify that it's being used consistently. If the financial statements are prepared externally, then that will be one of the things that the CPA firm will determine and tell. And so you would just look at the notes to the financials to see that. Also, if you're doing a comparative analysis, you're comparing with another firm, be sure that you're comparing apples with apples, not just with the same type of business, but that they are using the same cost flow assumption. And as I indicated before, the assumption not only affects the income statement, but also affects the balance sheet. And the inventory here would be 10 versus 15 over here versus 5. So we want to know what cost flow assumption was used. Another critical point to note here is the notion of leverage. Leverage here would be illustrated by you trying to lift a heavy item. If you use this notion of a fulcrum, then you put the weight here and it would generate a lift in that heavy item, as opposed to just trying to lift it by itself. Well, we have a similar idea with the income statement. And what we ask is, well, if you generated an additional sale of $5, or better yet, 5%, what would that mean for your profit? Would your profit go up by 5%? Would it go up by 10%? Would it go up by 1%? That's what we are looking for when we talk about operating leverage. What will happen to your profit for a given percentage change in your sales? So in this particular example, we have two different entities. ABC is one and XYZ is the other. They both have $3,000 in revenue. They both have variable cost, and I should quickly define variable costs are simply those expenses that will vary with changes in your sales. For example, materials that you use to make a product. The more products you sell, the more materials you're going to use. So that will be an example of a variable cost. But there are some costs that will stay the same regardless of your level of activity. For example, rent. Your rent for a particular facility will not automatically change just because you increase your sales, or it won't go down just because you have a slowdown in your sales. You signed a contract with the landlord for X amount of dollars in rent, and that amount is expected to be paid regardless of your level of business activity. So that will be an example of what is called a fixed cost. Doesn't mean the cost will never change, but it's saying that the change is not driven by changes in your business activity. And of course, if you've ever done finance or managerial accounting, you know that there's a caveat associated with fixed costs. It's talking about relevant range. In other words, it depends on the given size of your business. If you were to significantly expand, then your fixed costs could change, right? So if you had to rent another facility because you're growing so fast, that cost would then be adjusted to a different level, even though it's regarded as a fixed cost. So we take these expenses, essentially that's what they are. So we have variable cost of 300, and we have fixed cost of 1,000, so $1,300 subtracted from the gross sales of 3,000, we're left with a profit before tax of 1,700. Same thing is true for this company, except notice that they have a higher level of variable cost versus fixed costs. Even though their total cost is the same, a higher percentage of their cost is variable, whereas a lower amount is fixed. And if you think about it, that could be advantageous because as your sales increases, this cost is going to stay the same and it's a smaller percentage. Whereas over here, we have a higher level of fixed cost, and that of course will also not change. So total cost remains the same for both. And you can see that the gross profit for each entity, it should be the same amount. So what we are looking at here is to calculate the degree of operating leverage. And to get that, we would take the contribution margin, which is your variable cost subtracted from your sales. So 3,000 minus the 300 would give us 2,700. And we're going to divide that by the profit before taxes, which is 1,700, and we get 1.6. What does this mean? This means that for every 1% change in our sales, our profit will increase, profit before taxes will increase by 1.6. It works the opposite way as well. If your sales were to decrease by 1%, then your profit before taxes would decrease by 1.6%. So this is good if your sales are increasing, but it would be bad if your sales were decreasing. Similar calculation for the other firm shows that their degree of operating leverage is 1.2. What does it mean? For every 1% change or increase in their sales, their profit before taxes will increase by 1.2. So what would happen then if sales were to increase by 10%? Remember, for every 1%, the profit will increase by 1.6. So if we have a 10% increase, then 10 times 1.6 would be 16. So that's a 16% increase in profit before taxes. So their new sales would go up by 3,300. Sorry, not go up by, but go up to 3,300 because 10% would be added on. And notice that their profit before taxes would increase from 1,700 to 1972 because of the operating leverage. If the same thing happened to the other firm with a lower degree of operating leverage, in their case, it's 1% increase in sales, 1.2% increase in profit. The 10% will result in a 12% change in their profit before tax. So their sales would be 3,300, but notice that their profit would increase to 1904. So the higher the operating leverage, the bigger the change is going to be in your profit for every given percentage change in sales. That's the good news. The bad news is if your degree of operating leverage is high and your sales decline, then you will have a significant drop in your profit before taxes as well. So what is favorable when you have an increase in sales would be equally unfavorable if you were to have a decline in your sales. Want to end not with the usual multiple choice questions, but some scenarios and ask you to think about what the response would be given the initial information. So the first one is net sales increased 5% in the current year compared with average increase of 3% in prior years. Sounds like a favorable piece of information, right? They have done 5% this year compared to 3% average that they have been experiencing in sales in the previous years. So on the surface, that sounds good. But what if you start asking questions and this is what you learned? That the economy experienced 6% inflation during that same period. Now, this information that once seemed so favorable may not be favorable after all. In fact, we could argue it's unfavorable because all or most of the increase in sales was probably due to inflation, right? Inflation, prices in general went up by 6%. Sales went up by less than 6%. And so it's very possible that 100% of their increase in sales was all from inflation. Again, your job as the analyst is to ask the questions and then you draw inferences based on the answers that you get. Let's look at another scenario. This time, net sales increased 5% in the current year and cost of goods sold increased by 6%. Doesn't sound good, right? You would want to have cost of goods sold increasing by a smaller percentage than sales. Because if this happens, then it means that your gross profit is going to go down. Well, what if we were told that the firm had to price match down due to competition? Doesn't necessarily make it favorable, but it at least explains what was going on. And so this would be an example of, let's say, Best Buy's competing with Amazon. And so their sales increased by 5%, but their cost of goods sold went up because they had to keep offering the price match down compared with what Amazon was offering. A third example, net sales increased 5% and cost of goods sold remained consistent at 45% of sales, right? Based on your common sizing, you would be able to get that kind of information. But operating expenses declined as a percentage of sales. Sounds good, right? Sales went up, cost of goods sold remained constant at 45%. Their operating expenses as a percentage of sales declined. So overall, that's good. However, what if we were then told that management increased bonuses to sales representatives. That could potentially make this into an unfavorable situation. Last, but certainly not least, net sales declined by 1% for the last 2 years, and common size income statement shows that expenses as a percentage of sales are constant. Not good, right? Because sales are declining. You would hope that your expenses as a percentage of sales would also decline. So again, unfavorable. However, what if you were told that the firm just signed 3 major multi-year deals with new large clients? Potentially could soften the blow, serve as a mitigating factor for what was perceived initially as a weakness. Now we realize that this company may be, in fact, taking off in terms of their increase in sales. I hope you found the information that I'd shared to be helpful, a value added one, if you will. Let me know if you have questions. I will be more than glad to share my thoughts in response to your questions or comments.